hope you're enjoying the Mortgage Administrator event so far today. My name's Simon Cockerill. I'm the Head of Sales for Kent Reliance, for Intermediaries and Interbay Commercial, part of the One Savings Bank Group. And I'm here today to talk to you about the current considerations for landlords in the current market. So it's really good to see you all, albeit virtually this year as opposed to face-to-face as it would normally be. As I say, I'm going to take the next 15 minutes of your time to look through the current considerations for landlords in the current ever-changing market. And we'll have some time for questions at the end as well. So the points that I'm going to cover off for you today are around the current market challenges, what that means in terms of us as lenders and how we've reacted throughout the last 6 months. And then we'll look at how those impact on the opportunities and the considerations that the landlord will now be assessing themselves. And as I mentioned, we'll move on to looking at how you, as the administrator, are a vital cog in the wheel of and how much you can help in this. But first of all, to consider why landlords and what landlords are considering, we need to talk through exactly what's happened in the market. And it's been a bit of a roller coaster, as you know, for the last 6 months. These are some of the headlines that you will have seen over the last 6 months. And right at the start of the lockdown period in March, the picture that was painted was one of a very gloomy one, to be honest with you. But actually looking back now in the mortgage market, things feel like they weren't as bad as they were expected to play out. And a lot predicted comparisons to the 2008 financial crisis, and some banks not making it out the other side. This situation was very different, and it wasn't led by the banks and their liquidity positions. In fact, due to changes in regulation made after 2008, a lot of the banks are in a much healthier position now. And this is why you've seen a return for most lenders back into the market in the last few months, which is a real positive for customers and also the mortgage world in general. Funding has become cheaper and more available to banks, but also the securitization markets, which funds the non-bank lenders, has been open. The biggest challenge, though, throughout all of this for the banks has been the lockdown of valuers and the inability for them to go out and value properties throughout April and May. We've also dealt with the mass migration of underwriters to work from home. And that was something I'm sure you saw in your own businesses where people were equipped to work from home as much as possible. Other important factors that have happened in the market was the introduction of furlough scheme. And this is yet to play out fully in terms of its impact on the market, because it could create increased unemployment and redundancies in some examples. Anecdotally, some of the feedback that we've actually seen that some potential first-time buyers have actually decided to carry on renting or to move out their parents' home and take on their first rental property rather than take that first step into the first-time buyer market. We've also seen some lenders withdraw their support of furlough income on mortgage applications, again meaning that there's more demand for the private rental sector. This is potentially not great news for first-time buyers, but actually it's good news for landlords potentially. Now, I'm sure you'll recognise this face, Rishi Sunak, the Chancellor of the Exchequer, one of the most recognised faces, I think, over the last 6 months. He's been responsible for bringing in a number of initiatives to help boost the economy. Payment holidays, let's call them deferrals though, because people do actually have to pay them back. The furlough scheme, which we've already mentioned, and also the term funding scheme. He also brought in the Eat Out to Help Out scheme, which I'm sure we've all enjoyed. I know I have, and hopefully for those that know me, I haven't changed too much by indulging in that too much. But all of these factors are designed to boost the economy. But the most important one for our market is that around the new stamp duty holiday that's been brought in on properties up to £500,000. And I don't know about you, but I've seen lots and lots of property coming onto the market. They've also been selling within a couple of days, which shows the impetus that this has actually achieved. It sparked an awful lot of interest with many, many people, but also many landlords will spot an opportunity. And of course, the impact on the market of a reducing stamp duty bill for landlords means that this could typically run into several £1,000s for them, a saving which they're going to take advantage of, as long as they complete before March 2021 at the end of the month. For anybody that was around in 2016, when the first initial buy-to-let surcharge was introduced, you'll no doubt remember the rush that happened to complete before that deadline. And we expect something similar to happen next year on the 31st of March, subject to the Chancellor not extending the scheme any further. But this definitely represents another stimulus into the buy-to-let market, with more people being potentially driven down the rental route and a subsidy making it more attractive to extend portfolio, for the financially savvy landlord. And we've already seen the short-term results of this. Whilst this slide shows in the main 2020 house prices have remained fairly static, at the very right-hand side of the graph, you can see a slight uptick in the house pricing. And we've seen Halifax announce in their house price index in August alone a 1.6% increase in house prices. And also, the average house price in the UK is now £30,000 more than pre-lockdown. The question is this a sustainable increase? The other element that's playing in it here is the fact that if property is being snapped up quickly and prices are rising, that puts pressure on people in terms of the actual mortgage size that they're able to achieve. So a strained affordability picture for people looking to purchase. So again, this might drive people down to the rental route. So considering some of the challenges that are actually influencing landlords' decisions, let's then flip that and look at what lenders are doing. And again, the starting point to go back to here is the start of lockdown in March. And whilst this seems like a fairly negative place to start again, it does play out the picture very well. Product choice has got better, and it's got better a lot quicker than people are anticipating. But in March, there was products everywhere. The shelf was full. Maximum loan to values in the buy-to-let space were at 85% loan to value across the market, and lenders were getting drawn into a bit of a price war, a bit like we saw in the prime world, to be honest with you. In fact, the average 5-year fixed rate at 60% loan to value in March was at 2.31%. And at the end of July, this had risen to 2.65%, having a direct impact on the interest rate that's paid. We've also seen the number of products available to landlords and lenders change. Products, there were 2,900 products in March in the 5-year space, which fell to 1,455, so almost half in May. These numbers have now increased, which is a positive, but landlords are still left with around only 60% of the choice that was there earlier in the year. But why is that important? Well, clearly, fewer lenders and products means less ability for landlords to fit their criteria, but a number of landlords will always look to maximise the lending that they've got in their portfolio and to leverage as much out of them as they possibly can. And the higher the interest rate, the less that they can take out, and that affects their decision making. So why have lenders actually done this? Well, it'd be very easy to say that this was purely down to pricing for risk, and that may play a part for some lenders. But for some other lenders, like ourselves, that have been largely open for business throughout, there's also the element that plays into this around service standards and actually the customer journey. And with underwriters working from home, we've had to adapt to capacity issues, and the pricing up has helped lenders deal with that. Don't forget that the lenders had to deal with a backlog of cases that they couldn't value throughout April and May. And a lot of these cases couldn't be valued with a desktop valuation, which all adds to the capacity issue. So given all of what we've talked about so far, what does this mean that landlords will actually be asking themselves? And all of the ones on the screen come into play, but specifically at this moment in time, I would say the current ones are the following. Do I structure my portfolio through personal ownership and continue to do so? Or do I seek some tax advice at this stage, how the changes in tax relief for landlords is impacting my portfolio and potential future changes in capital gains tax? Is limited company the right structure for me to take on board at this time? But remember, this is something they need to seek professional tax advice on before they make that decision. And that's not something that they should be advised by either the mortgage broker or yourselves to do. And as we've alluded to, can I get the loan size that I want? Or are the LTV restrictions being imposed by lenders, meaning that I have to put a bigger deposit down? Or can I gear up my portfolio to the maximum amount and cover the new purchase that way? 85% lending, as we said, was commonplace in March, but we're only just starting to see one or two lenders dipping their toe back into the water at that loan to value. And also, what property do I buy? There was a big shift before the COVID pandemic towards HMOs, houses of multiple occupation, and multi-unit properties. Do I stick with that strategy as a landlord, or am I interested in something new and exciting like holiday lets? Now the UK has seen a summer of staycations. Is that market long-term, or is it just a one-season wonder? The other question they'll be asking themselves is, whereabouts shall I buy? And again, pre-COVID, geography was a really hot topic. Do I chase the highest yield I'm potentially going to be able to get, in which case, as our Buy to Let Britain report said in 2019, the northwest is the area I should be looking at. Or do I want to speculate a little bit more and look at a future hotspot? The same report noted that the Midlands, the East Midlands in particular, and Yorkshire were the fastest growing areas in the UK, and they could be the one that the landlord decided to chase to take advantage of greater demand and future rental growth by speculating a little. So I hope that's been useful in giving you a bit of an oversight in terms of what landlords are currently thinking about. But where can you as administrators help? And what on earth does a traffic junction have to do with that vision, I hear you say? Well, the answer is pretty common in terms of the place of getting things right first time. And this scenario here that helps paint that picture, well, we've all been there, haven't we? Without a care in the world, driving down a road, take a wrong junction, finding yourself on a dual carriageway and realising you get that sinking feeling that you've wasted a load of time driving down to the next junction, turning around and then having to come back. But if you got it right first time and made the right junction, you would have saved yourself a lot of pain, a lot of heartache and a bit of time. And I'm sure we've all been there ourselves. And to make things slightly more difficult for everybody, the post-COVID world means the heavy lifting in the document process has just got a little bit heavier. I've already referred that furlough income and the acceptance in the residential market is changing, but other elements specific to the buy-to-let market have changed too. Many lenders will ask for a statement from your client, the landlord, on whether they suffered any rental void or taken payment deferrals throughout the recent period. And a lot of landlords saw mortgage payment deferral as a much needed break when they had rental voids. Some landlords saw it as an opportunity to help with the cash flow within their business. Either way, payment deferrals have an impact on the way that buy-to-let cases are now underwritten, and many lenders will ask for bank statements to prove that the mortgage is back up to date and the payments have been made or the rental income is being received. Some lenders might also spot a bounce back loan that was taken through the bank statements, but they might now ask for alternative deposit funds, as this can't be taken as a deposit. So you need to be alert for spotting these when you're submitting them to the lender and anticipate some potential extra questions if you do spot them. But also, remember, a lot of the lenders, when it comes to a large portfolio client, will do some of that heavy lifting for you. For example, at Kent Reliance and Interbay Commercial, we will help you input your client's portfolio onto our system to save you some time. Just speak to our team and they'll help you. So whatever stage you get involved in the process of getting a landlord a property, be it in the power planning of the deal itself, be it in entering application details through to checking the offer and getting the deal across the line and completed, you've got a number of resources that you can and should be leaning on to help you understand the changes. Firstly, engage with your BDMs. They'll be more than happy to help you, as they're as keen to get cases across the line from application to offer as quickly as possible, and can also help you understand the packaging requirements of us as a lender. Utilise the lender support functions too. We've all got phones, but like many now, including ourselves, we've invested in live chat as a different way of communicating with mortgage firms. The benefit of that is you get a transcript of the conversation should you need to refer to it in the future. Also, remember how previous cases have gone with different lenders, whether that be good or bad. Create your own case studies of what went well and when you experience a lesson that will help you in terms of future dealings with a certain lender. And lender websites all have submission guides which have been specifically created for your role in mind. And remember, whilst you use these guides and it gives you a really good example of what to get, any documents you send, especially bank statements, can create additional questions. So don't promise your client the end of the document request until you get that offer. And to give you a bit of an idea, these are the submission checklists that we produce at Interbay and Kent Reliance. We've even tried to add a list of possible extra documents that might take away some of the uncertainty and some of the additional questions that we might ask you. But also, you'll notice from the tick box, depending whether it's a portfolio client or not, an employed client or not, we'll tell you exactly what it is that we'll be looking for in terms of requests. And remember, lenders' underwriting teams are targeted, as are the BDMs, on operational turnaround times. So we're as keen to help you get it right first time as I'm sure you are and your customer are. And finally, why does the client need you? Well, listen, as we've just pointed out, the cases post-COVID now are more complicated to get through. So your role is imperative in terms of getting that seamless process through from application to offer. It also provides referrals for your business. And if you get Trustpilot or Google reviews on your business, that will draw in business too. So I hope you found that useful. Thank you for your time, and I hope to see you all soon.